We are live.
Great. Hello and welcome to Marcellus's yet another webinar. This
Pramod, can you hear us? Rakshit, you can hear us, right?
Yeah.
Pramod, your voice is breaking up a little bit. Okay, I'll take over. Who's controlling the slides, Rakshit?
I'm controlling, sorry.
Fantastic. So, folks, I think Pramod's line has got a little distorted. So I'll kick off the webinar and we'll talk about why the election results are close to ideal for our type of long-term investing. And then Rakshit will get into CCP, where it stands, why CCP has recovered nicely in the last year or so, and why we think CCP is set for a very nice catch-up where share price compounding catches up with the stellar EPS growth that the investee companies have shown in the post-COVID world. So I'll begin with a slide on why the election results are close to ideal for long-term investors like us. So I'll step back a little bit. If you look at India's GDP growth over the last 20 years, it's not made much difference. Actually, over the last 30 years, it's not made much difference which party is in power, whether it's a coalition government or it's a majority government. The country's done around 6.5% reasonably consistently. And by the way, the same holds true for stock market compounding. Where stock market compounding hasn't so much been predicated on is it UPA, is it NDA, is it a majority government, is it a coalition government? The stock market has compounded over 10, 20, and 30 years at such a stellar pace that over the last 3 decades, over the last 2 decades, over the last decade, we've been amongst the world's best markets. In fact, it's United States 1, India 2, or India 1, United States 2. These are the two big markets in the world and very similar markets. Just like in the United States, it doesn't matter whether the Republicans win or the Democrats win, neither matters for GDP growth nor for the stock market. Very similarly in India, stock market outcomes, economic growth outcomes have been broadly, resolutely strong, regardless of whether it's a coalition government or it's a majority government or the color of the government. Now, why is this? Why does economic growth and stock market outcomes not hinge as critically on coalition governments or lack thereof in Delhi? Part of the reason is the composition of India's GDP growth. If you take India's state level GDP growth, break it down, what you see is that roughly 60% of India's GDP growth comes from states, comes from regions where the color of the political outcome has very little to do with the economic outcome. So whether it's the NCR region, Gujarat, or Peninsular India, by Peninsular India, I'm referring to Maharashtra, Karnataka, Telangana, Tamil Nadu, Andhra, Kerala. Whether it is Peninsular India, Gujarat, or Delhi, these are the parts of the country where 60% of the growth comes from. There is very little linkage between which political dispensation is in charge of that state and the GDP outcomes in that state, right? And the result of that is you and I are able to get economic outcomes which are reasonably steady, regardless of what the political situation is, either in the state capitals or in New Delhi. Now, add to that, I think what's good about the recent results is the coalition government construct, I think, creates a burning platform. The burning platform, I'm sure for everybody who's listening, the burning platform must be obvious to everybody who's listening. Job creation has been weak for a couple of years. The post-COVID recovery has hurt the lower two quintiles of Indian society. If you want to see how powerful the negative impact of the post-COVID recovery has been on the two lower quintiles of Indian society, read Rama Bijapurkar's fabulous book, recent book on how wealth and income outcomes have got skewed. Wealth and income outcomes have got skewed in favor of people like you and me and against the two lower quintiles of society. With job creation weak, wealth and income creation weak for poorer people, naturally there's been a political blowback for that, and that creates a burning platform, which I'm sure the government that will take charge on 9th will respond to. There is a burning platform. I'm sure there will be policy responses which drive consumption, drive job creation, and remediate the misery that the poorest 40% of India has experienced over the last 3 years, right? There's another reason why I think the election outcomes are good. Typically, India goes through 5 to 6 year cycles. So in a 6 years cycle, the stock market tends to have 2 to 3 years where companies with weak accounting, weak governance tend to have a bull run, right? This is typically happens in a bull market. In a bull market, people say, forget the governance quality, forget whether the promoter is a naughty man or not. Let's just buy because it looks optically cheap. And in a rising tide of a bull market, even low quality companies get dragged up. And that's broadly what's happened in calendar year 22 and 23. Most of the companies with weak accounting scores in our forensic framework have done brilliantly. Unfortunately for you, for those of your Marcellus clients, we don't invest in companies with weak accounting scores. But as I'm sure most of the 424 people listening know, many companies with weak accounting have had seen their share prices triple or quadruple over the last couple of years. I reckon that party is close to ending. I won't be able to tell you which week or which month the party ends for companies with weak accounting, but this sort of political outcomes tends to be a precursor. This sort of political outcomes tends to be a precursor for poor quality accounting stocks having an almighty blow up, right? So I think a good result for those who want to see consumption revived in India. Good result for those who want to see a proactive, energetic government continuing to drive with high energy execution. And if you then come to how our portfolios are placed, because that's the core of the webinar, where is CCP placed? Step back and think about the macro landscape, right? Whilst consumption might be weak, corporate India's debt equity ratio is at a 20-year low. Corporate balance sheets are in superb shape. The banking system is also in superb shape. In fact, the tier 1 capital of the banking system at 16% is actually not just a 20-year high. It's the highest in the world amongst the big economies in the world, right? 16% tier 1 means that the banking system is in super shape. Corporate India's balance sheets are in super shape. Therefore, you and I shouldn't be concerned about the economy, right? The economy should not be a concern. And if you look at our type of portfolios, we look at CCP. Rakshit will take you through the stocks, but it's a play on premium consumption. It's a play on healthcare. It's a play on knowledge-intensive exports such as pharma, and it's a play on private capex, right? So this combination of private capex benefiting from corporate India's great balance sheet, premium consumption benefiting from the rising wealth of the people who are on this call, healthcare, natural area of boom as the country goes up the per capita income chain, and knowledge-intensive exports, a natural beneficiary of China +1. This construct is beautifully placed in India. EPS compounding has been stellar, absolutely stellar. F24, F23, F22, year after year, these companies have gunned out superb EPS compounding way ahead of the Nifty. As I'm sure all of you know, share price compounding has lagged. Share price compounding has lagged EPS compounding. The chart on the right-hand side illustrates the same, right? The red line chart is the earnings growth of the CCP, stellar, steady progression in earnings. That's why we call it consistent compounders. But the dashed blue line is the market cap. That's where CCP has lagged the Nifty over the last couple of years. Needless to say, this sort of political outcome creates the conditions for a catch-up. Your earnings growth is like this, your share price compounding has been like that, and you get a catch-up. If there was no catch-up, honestly, there would be no need for us. All you'd have to do is look for companies with great EPS growth and buy them. The fact that EPS growth and share prices don't always move in lockstep is why people like us have a job, and elections like the one we've had recently create the ideal conditions for a catch-up. Is there something for you to worry about in this sort of political landscape? I think there are a couple of things you and I need to keep our eyes on. Firstly, we'll have to see what the first budget after the election. This is in July. I think it'll be 12th or 13th July that the first union budget will come up. We'll have to see how the coalition government plays its cards. As I said, there will be obviously enormous political pressure for welfare benefits for the poor. But if they do helicopter drops of cash, we'll be disappointed. If they come up with sensible policies to create jobs, to do Ayushman, a step up in say Ayushman Bharat, a step up in PM Awas, those are the sorts of things which I think will be encouraging for stock market investors like us. So that first budget in July, I think, is critical. The second is the private sector revival. Remember, our portfolio contains private sector capex stocks. Private sector capex has only started reviving in the last 6-7 months. It's a nascent recovery. We'll have to see whether that holds in light of the political outcome. And the third, in a way linked to the stock market, linked to the election pieces, this got a crazy sign up in retail investors that we have seen. 3 years ago, India had 30 million retail investors. Today, India has 120 million retail investors. Um, Actually, India today has 150 million retail investors. We've gone 30 to 150. So we've added 12 crore. India has added 12 crore retail investors in the last 3 years. Looking at the sort of stocks they're buying, looking at the crazy surge in F&O volumes, it's not clear to us that a lot of this is sustainable. And the question is, when does this incredible retail investor party, right, managing 12 crore people, 120 million people have come on and basically started punting on F&O and on small cap stocks. We don't quite know how this party ends. Our hope is that it doesn't end in a disorderly way with a meltdown. So those are the three areas to be careful about, right? The first, budget. Will the government turn sort of needlessly populist? The private sector capex revival, and the retail investor. How will the retail investor fare now that the road ahead gets a little choppier? We'll keep an eye on those. My reading is CCP is reasonably well insulated from these three risks, and CCP is well placed to benefit from all that is good about our country, which is elite consumption, premium consumption, knowledge-intensive exports, the ongoing privatization of health in the country, and finally private capex. So great setting, I think, for long-term investors. If you fancy yourself as a long-term investor, I would urge you to think more about putting money in CCP. If you believe that PSU capex stocks PSU stocks will continue doing well, I'm sure you know where to go. But let me turn to someone who's analyzed high quality investing in India, I think more than any other person in the last decade. Let me turn to Rakshit Ranjan.
Thanks, Saurabh. Good morning, everyone. Thanks for dialing in. So kicking off with the usual table demonstrating the improving and consistent fundamentals of the CCP portfolio. Key points to note here: profit after tax growth. You can see. Let me annotate parallelly. So profit after tax growth has been compounding in FY24 at high 20s, around 27%. Now this is on a healthy base of 20% CAGR that we witnessed in this portfolio over FY19 to 23. We've displayed in the bottom row median numbers instead of weighted averages for a specific reason, because something like a trend where FY24 profit after tax for Trent was 336%. It would skew the overall average, and hence the median of 28% in FY24 is quite clearly a representation of how the portfolio compounding has been on profit after tax. Also notice here that the median historical capital reinvestment rate has jumped up to 76%. Right. If you look at the current list of companies in the portfolio over the last 4 years, FY19 to 23, 3/4 of the operating cash flow that they have generated, they have reinvested that cash flow back into driving new business initiatives and driving growth of the core businesses. Alongside that, the median ROCE, median return on capital employed, which used to be in the mid 30s, has now trended towards sort of mid to high 20s. You can see FY19 to 23 it was 25%, FY24 it was 27%, and that both of these changes are reflective of the kind of upgrades to the portfolio construction that we've made, where we are investing more in companies with high rates of reinvestment of capital, with healthy returns on capital employed of 25 to 30%, driving profit after tax compounding, as I mentioned, 28% in FY24 on the back of 20% in FY19 to 23, and similar run rates likely in the time periods to come. Now, how does it compare against the portfolio performance? Well, before portfolio performance, this is where the valuations stack up. So the chart on top, let me quickly explain what the two lines mean. The red solid line is the ratio of weighted average price to earnings multiple of CCP's current portfolio for different years in the past, divided by a weighted average Nifty 50 price to earnings. These are all 1 year forward for both the numerator and the denominator. Effectively, our portfolio has consistently been trading at about twice the price to earnings multiple of Nifty 50 for the best part of the last 1 decade. There is one slight aberration worth bearing in mind. A trend within this is a large weight in our portfolio. You know, it's a little higher than 10%, and Trent is trading. It has consistently been trading at above 100 times. So that is one stock which skews the weighted average. If you strip that out, the portfolio price to earnings weighted average is around 1.8, 1.7, 1.8 times that of Nifty. Compare that against the dotted line. Dotted line is a weighted average ROE of the portfolio divided by weighted average ROE of Nifty 50 constituents, right? In effect, you can see the ROE is also roughly 1.8 to 2 times pretty consistently for this portfolio vis-a-vis Nifty. Another way to look at it is the table at the bottom, encircled part on the right, where the top 4 rows are fundamentals of CCP, and the bottom 3 rows are corresponding metrics for Nifty 50. The way to read it is Nifty's median return on capital employed is 15% for our portfolio. The weighted average capital employed is 26%. Nifty's profit after tax compounding has averaged around 10% for this portfolio.
I think Rakshit, probably worth giving the intuition as to why the ROE ratio should be broadly the same as the valuation wala ratio.
Correct. So
yeah.
So effectively think of it like this. On the same 100 rupees of capital invested by an average Nifty company, there is 10%, as in 10 rupees of profit that those Nifty companies generate, right? Sorry, not 10, 15%. So 15% is the ROCE of Nifty. What that means is, on average, on every 100 rupees that a average Nifty company invests, they are generating 15 rupees of profits on it. The CCP companies generate around 26, 27 rupees of profit on the same 100 rupee of investment, right? So the cash generation on the same capital base for the CCP companies is roughly 1.7, 1.8 times the cash generation of Nifty. Now, that's one metric. The second metric is what happens to this cash. This cash then goes towards reinvestment, which drives growth. So the growth of that cash generation, you can measure it by profit after tax on a like-for-like basis here. More ideal is free cash flow, but we don't have Nifty 50's free cash flow because there isn't a positive free cash flow of average Nifty 50 company. But profit after tax compounding for Nifty is roughly half that of the profit after tax compounding of CCP. So CCP generates twice the quantum of cash, more or less, and twice the run rate of growth. And hence, CCP trades roughly at twice the price to earning premium. Now, this doesn't capture one other element, which is the average longevity of a Nifty company versus the average longevity of a CCP company. So even if you leave that factor aside, the average longevity of CCP, which we believe is significantly higher than the average longevity of Nifty, even if you leave that factor aside, the quantum of cash generation and the rate of growth of that cash generation is roughly 1.8 times for CCP over Nifty, and hence the price to earnings premium being 1.8 times for CCP over Nifty is quite reasonably justified.
I think it's also interesting if, in the light of what Rakshit is saying, right? You can see that until COVID hit us, the orange line and the blue dashed line broadly move in lockstep, right? And as Rakshit is explaining, the ROE premium of the portfolio should broadly reflect the valuation premium of the portfolio, and that held true till COVID hit us. And then in the aftermath of COVID, because other companies in the country got hammered so badly, this portfolio, the CCP took off, and you can see the orange line heading towards that 3.5 wala Mount Everest type situation. And naturally, in COVID, the ability to reinvest surplus profits of all companies, especially the CCP companies, also got hit. So the blue dashed line comes down, and then the orange line heads up towards Mount Everest, and that in turn helps you understand, and in retrospect helps us understand why after the peak of COVID passed, why for a couple of years we underperformed. The orange line then heads back, the valuation normalizes, but the blue line and the orange line are hugging each other again. Normal service seems to have resumed again, and provided the blue line and the orange line hug each other, you and I will compound broadly at the 20% rate that CCP historically has compounded. But that the disconnect between the blue line and the orange line is where CCP suffered. In retrospect, had we been cleverer when that 3.5 ka peak was hit in the orange line, we should have stopped taking money. We should have done a lot of things. And we are wiser for that experience. Future, we'll try to do that. But the effect of the orange line heading down and the blue line and the orange line hugging each other again, the effect has been quite positive. And Rakshit, if you could just take investors through that cycle. Yeah, this is it. Yeah, go for it.
Yeah, so this is the chart depicting the last 5.5 years journey of CCP. The legend in the red box at the bottom, it gives you the definition of the three phases that we have described in this chart. So phase one is the inception, December 2018 to sort of end of COVID, December 2021. That's sort of a 3-year period. The bars on the left, the 27% versus bars on the right, 17.7. That was the performance of CCP relative to Nifty 50 Total Return Index. The second phase was the painful period. This was the 15% underperformance period. Roughly all returns here are annualized. They are not absolute, so they are CAGRs, regardless of the length of the phase. Nifty delivered in the second phase a little over 1%, and we delivered -14. That was the painful underperformance that Saurabh talked about. And now the catch up that Saurabh initially mentioned is underway. In the last sort of year, a little over a year, the absolute returns have recovered very meaningfully. Relative returns, there is still a marginal underperformance vis-a-vis the Nifty 50, but some of the factors of that Saurabh mentioned, we don't see that kind of an underperformance at a 25% run rate being a sustainable feature. 25% analyzed run rate, and hence now coming to how we are positioning the portfolio to deliver performance in the years to come. So this is about a few changes that we've made to the portfolio. We've reduced allocations in some stocks. We've exited from a couple of stocks out of the list on the right panel on this slide. And we've increased exposure, added a few stocks, which I'll come to in the next slide. Now, last 2 years, in a way, gave us an opportunity to accelerate our learning and evolution in the portfolio construction process. We continue to persevere with our strengths around identifying high quality compounding businesses, and we have identified areas where either we should reduce exposure because the expected total shareholder return is dropping due to its earnings growth moderation, or due to, say, significantly rich valuations, of which we can benefit from by reducing a little bit of exposure at the peak on valuation and doing the reverse if the valuation troughs. So we've reduced exposure to businesses where either the earnings growth is affected by macro headwinds or regulatory headwinds. For example, there's weak industry growth expectation for the Indian IT services, and hence TCS's allocation has been cut. Or, for example, there's weakness in domestic consumption that we had been undergoing, and hence as that continued, we cut our exposure to Page. Secondly, we have reduced exposure to areas where businesses face regulatory headwinds. For example, say Kotak, HDFC Life. These are two stocks where regulatory changes we believe can lead to a moderation in earnings growth over the next couple of years, and hence reduction in our exposure there. Thirdly, as I mentioned, areas where valuations are at peak. So Titan, we trimmed our position size when it touched 75 times price to earnings, and on the horizon, we could see the risk of both lab-grown diamonds as a new disruptive trend possible. At the same time, gold prices shooting through the roof means certainly that some competitors were sitting on commodity of gold as their raw material, owning that inventory. They have massive inventory gains once the gold price rapidly rises up before they sell that inventory to the customer. And these inventory gains, they tend to pass it on via price cuts, increasing competitive intensity for the entire jewelry space, and hence a little bit of a couple of percentage point moderation for the jewelry franchise for Titan. So we cut the exposure there.
Actually, if you don't mind just stepping here, folks, one of the things that we're trying to do here, right? And Rakshit's put a stellar list of companies up here, companies that many of us would say are the best that India has produced in the last 20 years. But one of the things that's become clear in the last 4 years is access to funding has improved significantly in our country. So the banking system, as we've discussed, is in good shape. Venture capital funding, whilst it's temporarily cooled off in the last year or so, even after the cooling off in VC funding today versus 10 years ago is much easier to get. Private equity funding today is much easier to get than it was even 4 or 5 years ago. Foreign investors like investing in India, partly because China is a country which is falling apart. With access to capital being much easier today than was the case 5 years ago, companies who are not reinvesting aggressively, companies who are not proactively strengthening, muscling up their businesses, are falling behind. And our job has become a little tougher. Our job has become a little tougher in saying that if we see our investee companies even relaxing the slightest, if we see the CEO, the promoter, the management group relaxing the slightest, if reinvestment rates are coming off a little bit, there's a sign of lethargy, we need to get out of there. This intensity of competition step up, perhaps we could have been a little sharper on this, say, through 2021, but better late than never. Over the last 12 months, as Rakshit is describing, we have pruned the portfolio, upgraded the portfolio to bring into the portfolio clean, well-run franchises, but who, alongside being clean and well-run, are also super hungry. And as Rakshit's already highlighted, reinvesting 80%, 90% of their free cash flows. Remember, there's multiple bits here. If the promoter is corrupt, if the accounting and governance is weak, then no point us looking at the company's aggression, because a corrupt and aggressive promoter will not make you and me money. So we firstly need the high quality governance and accounting, but we also need that to be combined by incredible levels of proactivity and intelligence on the promoter's part to keep pushing the franchise forward, keep generating high return on capital, and then slamming 80, 90% of the surplus capital back into the business. I think in 2021, partly because of sitting at home for 2 years, we've become a little complacent on this subject. Over the last year, we've become super, super aggressive about the subject. And through the weekends, most of us spend time on the road meeting new companies who tick all 3 Marcellus boxes: clean accounts, good ROC, good return on capital, strong franchises, and reinvesting large amounts of capital back into the business. Rakshit, you might want to step into the positive side of what we have found in that regard. Yeah, here we go. Back to you.
Yeah. So also, it's not an absolute decision all the time to reduce allocation. It's also a relative decision. In many cases, better quality substitutes become the reasons for reduction in exposure. So where have we increased exposure or added stocks? Firstly, companies with a strong core business, and on top of it, several optionalities in terms of new business initiatives, which can accelerate the overall earnings growth trajectory into the future for that firm. This is a very big piece of more than 50% of the portfolio as it stands today. Effectively, this more than 50% of the portfolio allocation today has got a core engine, a core which has delivered very consistent history, a core which has delivered very healthy returns on capital employed in the past. But also in the last 2 or 3 years, this 50% of the portfolio allocation is to businesses where in the last 2 or 3 years, that core cash flow has been redeployed to germinate new business growth drivers, which are not going to start moving the needle for the overall franchise 10 years out. They will move the needle for the overall franchise this year or next year, imminently, right? And hence, earnings growth rate expected from many of these companies is significantly higher than the kind of companies from where we have taken exposure off, right? So that's one big piece of where we have increased exposure. The second piece is companies where valuations are reflective of significant discovery element of greatness yet to happen, right? So, for instance, there are two types of this. One is the P multiple itself is low. The second is the P multiple is only optically high, and a lot of the upside is not factored into the market cap because the PE multiple is optically high. The former example is something like, say, Narayana and Aisha. Narayana's PE multiple is one half or one third compared to its other reputed competitors, such as, say, Max Healthcare operating out of North India. Narayana's PE is significantly lower. If you try to understand the business model, according to us, the business model is superior. When it comes to the second type of example, it's a trend, right? Many businesses were germinated by a trend over the last 3 or 4 years. Zudio was the first one to deliver. Star Bazaar is the next one that has started to deliver, and you'll see just the way Zudio got appreciated by the market over the last 2-3 years in trend share price, a Star Bazaar, and then a Misboo, and then there are a few more in the germination stage. Over the next 2-3 years, we expect those to also get reflected. So that valuation piece of lack of discovery is the second area. And the third area, which overlays on the first and the second part, is industries that are undergoing tailwinds, such as, say, either private capex around manufacturing. So tube is a great example, or let's say electric vehicles as new disruptive growth territories. Healthcare, massive growth driver in terms of the external environment tailwinds, and we are undergoing a massive housing construction boom as well. We've added exposure in some of those areas, Astral, for instance, right? So these are the areas to quantify for most of these companies where optionalities exist. Expected earnings compounding is actually in the mid-20s. Returns on capital employed are very high, not 35 to 40% for the overall portfolio average. As I said, the overall average has come down to, say, 25 to 30%, but reinvestment rates have stepped up. CCP's average.
One way to sort of illustrate the power of this is if you just go back to that three-phase wala slide. If you go back to the three-phase wala slide, had you not made these changes, right? Had you not brought this new blood into the portfolio, that phase 3 return, which is 26.7%, wo kitna hota without the new blood, Rakshit?
About 10 percentage points lower. So we did this maths. 1st April 2023 portfolio, if we had not made any changes to that portfolio and let it run the way it was on 1st April 2023, FY24 performance would be 14% against 24% what it actually was till 31st March 2024. So it's a 10 percentage point gap that in the last 12 months got added because of the changes. Now, I mean, these are some quick examples. We can go through these in the Q&A, but effectively the same three-legged framework applicable to all the additions. Strong core, generating high cash, high run rates of cash, and then optionalities getting created, which are actually synergistic in many cases with the core, driving very high capex to CFO ratios, driving very high reinvestment rates in effect, closer to 80, 90, 100%, and plugging into many macro tailwinds that we expect these businesses to witness. Now, what does it really mean in terms of overall returns going forward? First of all, needless to say that we'll keep sticking to the CCP attributes that you can see in the first part of this screen. We want to buy high quality, cash generative, deeply moated businesses. There is no point of sort of losing discipline around that. We also want to buy institutions when it comes to their decision-making processes, rather than in Hindi, as they call it, Lala Ji ki Dukaan. And we want to buy very, very prudent and aggressive capital allocators. Both prudence as well as aggression are important. However, not just prudent capital allocation in the core, we want to buy companies with prudent and aggressive capital allocation towards non-core, as I talked about, optionalities, and hence not just longevity, but also lack of discovery of the quantum of growth in many cases, despite many of these companies being large and well-known businesses, becomes not just longevity as a driver of our performance, but also discovery of optionalities as a driver of performance, or discovery of quantum of growth through the optionalities as a driver of performance going forward. And as sort of quantified, position sizing changes, adding an extra layer on top versus keeping a portfolio steady, unchanged over long periods of time. This does mean that there will be, let's say, instead of what we used to guide previously, 10 to 15% annual churn in the portfolio, it will be more like a 15 to 20% annual churn in the portfolio, an extra 5% annual churn. But against that extra 5% annual churn on position sizing, where at, let's say, 3,700 rupees a share, Titan was shaved off, and at relatively lower valuations, entries into new stocks, say a Trent was added at 2,000 rupees a share. These increases and decreases in position sizing will add extra few hundred basis points to the performance in exchange for the 5% extra churn. So that's in a nutshell what you should expect the portfolio to see in terms of growth prospects going forward. I'll stop my presentation here in the interest of time and request Pramod to take up a few questions.
Sure. Thanks, Rakshit. Thanks, Saurabh. So, folks, we have Saurabh for another 20 minutes. Rakshit will carry on. So if you have any questions, please put your questions in the Q&A box. We'll try and take as many as possible. So, Saurabh, first question is around the three risks you mentioned. Say, for example, should there be populism in next month's budget? How do you see the impact in terms of companies, sectors, markets, and how are we positioned through CCP and some of our other portfolios?
Yeah, so I think in a way, the bond market is already worried about that. The Indian Government of India bond yields are running up. The bond market is already fearing that the coalition pressures will result in the government having to do populist spending. So if and we don't know at this stage, if the government does do populist spending, you'll see obviously the budget deficit slip, potentially inflation rises. The RBI, which has shown no willingness to cut rates as it is, I think the RBI will become even less willing to cut interest rates. And therefore, the cost of capital climate in India, which has improved significantly in the last 4-5 years, potentially deteriorates, right? Now, ironically, Pramod, the portfolios that we built, especially CCP amongst our portfolios. CCP ironically is better placed in a high cost of capital climate than perhaps any other portfolio in our country, because these companies, Rakshit, just go back to the ROCs, the slide which shows the ROCs. Our investee companies have very high ROCs, right? So if you see the final column, ROCs of our investee companies are approaching 30%, which means that our investee companies can finance their growth themselves, right? So they don't have to go to the banks or the bond market and raise money to finance growth. So if we end up with a populist government, and I still believe it's a big if, I think the BJP especially will hold its nerve. The BJP tends to be fiscally conservative, and I expect the BJP to hold its nerve and not be profligate. But in the unlikely event of welfare spending going through the roof, budget deficit slipping, inflation going up, the Government of India bond yield going up, the RBI being reluctant to cut rates, this portfolio is beautifully placed because these companies finance their own growth. And there are very few companies in India with this sort of ROC. And therefore, there are very few companies in India who can refinance growth through their own steam. Right. So if you're worried about populism, then this portfolio becomes even more compelling. But as I said, I don't expect to see runaway populism in the July budget. I appreciate that the Maharashtra and the Haryana elections are 3 months away, and those are big elections. And obviously, there'll be pressure on the political dispensation in Delhi to deliver election victories in the Maharashtra and Haryana elections. But I still, having seen the BJP over the last 10 years, I expect them to maintain fiscal discipline in the forthcoming budget.
Fair enough. And in terms of capex, given you mentioned job creation will be one of the key takeaways for the government based on the elections, how do you see their capex change or get tweaked? What could they do to sort of realign the whole capex strategy towards labor-intensive sectors?
So look, we've been speaking to the policymakers over the last couple of months, especially when the politicians were running around doing election campaigns. The civil servants were a little freer, and their view is that PLI has worked beautifully in mobile phones. iPhone, $20 billion of iPhones being exported from India, they believe is a sign that the PLI production-linked incentive has worked for mobile phones, and they want to ramp the PLI piece up. I don't think there's any doubt that the PLI piece will get ramped up. The second thing that I'm hearing talk about, Pramod, is that there might be employment-linked incentives, right? The government might say that if you employ more people per person, you, the company, will get an incentive, right? So that's distinct from PLI. Maybe we will get ELI as well in the budget. Thirdly, I think PM Awas was a brilliant program. I mean, we've traveled extensively around the country. PM Awas works beautifully. You give low-income people 2 lakhs. The government gives low-income people 2 lakhs. Then they go off to an affordable housing finance company such as Awas, which is in our small and mid-cap portfolios. Awas lends 10, 12 lakhs, and the low-income family ends up purchasing a house. The construction of the house creates jobs, cement demand, paint demand, tile demand. I think PM Awas should be coming back in this budget. I couldn't for the life of me understand why the government hasn't had PM Awas for the last year and a bit, because I think it's a very successful program, very popular program, and I think that it'll make a comeback in this budget. So jobs piece, PLI, I'm pretty sure they'll be doubling down on PLI. Hopefully there'll be ELI as well, employment-linked incentives for companies. And thirdly, PM Awas gets ramped up. I'm hoping we won't see free dole-outs and helicopter drops of cash. That's the kind of thing which creates runaway inflation and makes it very difficult for the rupee to hold its value.
Right. So I know we are more bottom-up investors. We like to look at businesses and then look at policy changes, adding a few percentage points in terms of growth. But for those who are interested, any particular sectors that are likely to benefit from this ELI sort of a scheme or tweak in the policy changes?
Right. Look, I mean, if you really want to bet on ELI, then footwear is one sector which tends to be labor intensive. So footwear companies will end up with heavy subsidies from the government on the ELI piece. This entire the electronic manufactured services piece, much of it is actually labor intensive. The iPhone manufacturing certainly is. So companies who are making labor-intensive electronic components, for example, phone assembly, they also potentially stand to benefit from ELI. So yeah, look for labor-intensive sectors. Footwear and EMS are two sectors where the companies tend to employ lots of people, hence could benefit from the ELI piece.
Fair enough. On the private sector capex piece, you said that it is one thing to watch out for. There is a nascent recovery. What could, I mean, and before that, there's one question on why has private sector capex taken so long to take off? Is it because companies are waiting for the elections, for political stability to start loosening their purse strings, or is there a bigger picture in terms of threat from imports which is holding back? And we also know consumption hasn't taken off. So a lot of consumer-oriented industries is still languishing in terms of utilization levels. So what could sustain this nascent recovery? And as a corollary, what could derail this recovery, given that you highlighted the risk?
So look, there are two challenges I think the economy faces. One is more recent and one has been a perpetual bugbear. The perpetual bugbear is our companies find it almost impossible to be competitive in the world market when it comes to manufacturing, right? We're brilliant at IT services. Anything which has a knowledge component, such as say Divi's lab and API, we're good at that. So wherever dimag, brains are relevant in exports, we are globally competitive. But if it's standard manufacturing, clothes, sports goods, even electronic products, it's been historically a really tough slog for India to be globally competitive. As we just discussed, courtesy PLI, courtesy basically a subsidy from the government of India, we've managed to create the beginnings of a electronic manufacturing services industry, which can be globally competitive, but they're globally competitive courtesy the PLI. If you take the PLI away, will they be globally competitive? I'm not so sure. So that's been a historical problem. The wages are too high in India, given that labor productivity is low. Our wages are high. Land is bloody hard to get and it's expensive. And cost of capital, SME working capital, especially 10-11% compared to say SME working capital in China costs 2-3%, right? So land labor capital, we are much higher cost than other countries with a similar stage of development. They're not competitive vis-a-vis Bangladesh, Vietnam, or China. That's been a historical problem. Hopefully, the PLI piece can partially remediate that. Fingers crossed. If it does, then I think we will see more capex in export-oriented sectors, right? So Divi's lab again, good example. Divi's lab has significantly ramped up capex on a new plant. The new plant is making contrast media for the global majors, for the Mercks and Pfizers of the world. It's a China +1 play at some level because China dominates contrast media. Divi's lab is muscling in because the Western companies are apprehensive about China. So hopefully we will see the manufactured exports piece come into life as lesser companies than Divi's lab find that they're able to compete in the global market. This is a historical problem. Let's hope the PLI piece partially remediates that. The new challenge which has emerged in the last couple of years is consumption has conked off comprehensively, right? 2-3%. The GDP data is saying 2-3% growth in consumption. That's those are 20-year lows on consumption. What that's done is domestic companies who focus on consumption, they are saying, boss, growth hi nahi hai, so why should I do capex, right? So therefore, the domestic consumption piece has to be revived for capex, which is centric on domestic consumption to fire into life. I'm sure there'll be lots of high-powered policymakers in Delhi who will burn the midnight oil between now and the budget to figure out how to revive domestic consumption. It has economic implications and it obviously has political ramifications as well. If consumption revives and the PLI piece fires into life, Pramod, we'll see a solid private sector capex revival.
Fair enough. And the last thing on the macro election related question is, given your interactions with foreigners, how do you think, and especially foreign institutional investors, let's say we'll keep FDI out of the loop, how does the external world look at these elections in terms of their appetite for India? I know we don't invest basis whether foreigners will buy or not. We are investing in good companies as it is. But to the extent that we've highlighted the FII exit affected our portfolio, maybe the question is coming from that perspective. How do you expect FIIs to look at the Indian market?
So there are two constituencies in the FII market. There are one group of people who say we want political clarity, we want a decisive a single party to be in power. We don't like any of this coalition business. And they, by the way, they told us this before the election as well, that they much prefer a simple political situation where one party rules the roost and runs the show. And as you can imagine, these people have invested heavily in China over the last 20 years. And what they've got out of China is, I think, 5% dollar CAGR over 20 years, right? So their experience in China has been poor, in spite of the fact that the Chinese Communist Party has run the country. But they still believe that they want to invest in countries with one decisive political winner running the show. So those people obviously are not going to be jumping for joy at the coalition outcome, and those investors, I suspect, will hold back from committing to India, at least for the first 6 months of the new government's life. But there's another group of investors, there's another group of FPIs who've been long-standing India fans. Historically, they've invested $100-200 million in India. They understand that in India, the economy is resilient. The political setup is diverse. There's state governments, there's central governments. They understand that India compounds both economically and stock market-wise, regardless of whether it's a coalition government or it's a single-party government. They've been making money in India for 20 years, albeit on, say, $100-200 million of investments. And they are saying, given what we know of India and given what we know of China, we want to load up big on India. I think that constituency, Pramod, will come into the market over the next 2 to 3 months. And our job will be to convince some of those people to give us some of their money. FII's investment in China is $3 trillion. Their investment in India is $600 billion. So they got 5x more money in China than India. Even if you assume that the ardent China fans and FIIs who like to see strong, decisive governments don't come to India, even if you assume that only $500 billion moves out of China to India, and assume conservatively that $500 billion moves to India over a 10-year period. So $50 billion per annum of flows, and therefore $500 billion comes into India. Basically, over a 10-year period, we should be able to see a doubling of FII interest in the market. And if they come to India, more likely than not, they are likely to invest in the companies that we are staring at on the screen.
Fair enough. So whilst I have you, before we let you go, one last question. There are similar questions in various shapes and forms, but I'll just put them together as a single question. There are people who are saying that they like our investment philosophy. It's fairly simple to understand. They trust it works in the long run. But given the experience over the last 2 years, they would want some sort of a guidance, comfort in terms of what can they expect as returns, both absolute returns and versus the Nifty, so that they can stay invested for the long run, which is the whole point.
Sure. So I think the screen in front should be a good starting point. So let's start with the screen in front, and then I'll make it a little bit more complicated. Any company, whether it's listed or unlisted, broadly will grow at the same rate of its reinvested ROCE. So if you look at the last column, ROCE is 27%. If you assume 100% of that ROCE gets invested, then you should get PAT compounding of also 28%. But most companies, as Rakshit has already explained, are not going to invest 100% of their ROCE. Some of it will go in dividends. The dividends are useful for a variety of reasons, such as financing the promoter's lifestyle, giving shareholders a nice cash payment every year. So assume that capital employed or reinvestment or ROCE, assume that reinvestment or ROCE is around 80%. If you reinvest 80% of roughly 30%, you're growing your capital employed at 21-22%. Right? If you grow your capital employed at 21-22%, your PAT compounding, your growth in profit should be broadly in that vicinity. 21-22% is your growth in PAT. The numbers, the FY24 outcome is spectacular, but the FY19 to 23, if you look at the FY19 to 23 period, you see that PAT compounding around the 20% mark. That should be very, very doable for companies of this caliber over the next 5 years, right? So assume conservatively 20% PAT compounding. Rakshit, now just go to that slide, the slide where you show the relative PE of Nifty and relative ROE, right? Now, if PAT compounding is 20% and the PEs hold steady for this portfolio, remember this portfolio's PE premium to the market is back to 2.4, the orange line, right? So it's not as if the portfolio is radically more expensive than the market. It's historically been around 2.2 to 2 times. It's at 2.4. Assume that the portfolio's PE holds up relative to the market. If the PE stays stable, PAT grows at 20%, you end up with 20% compounding. Let's be conservative. Assume that the PE derates, right? For whatever reason, the PE derates at the rate of 2-3% a year or 3-4% a year. You should still end up with returns which are in the 15-16% area. In fact, on this round trip, we started live in CCP in November 2018. From November 2018 to now, gross of fees, CCP has delivered around 17.5%. And if you assume that the PE derates, you'll still end up at that 17% mark. With 20% PAT compounding, some PE derating, you end up with gross returns of 17%, net returns of around the 15% mark. And that's my conservative view, that if you want to invest in this, don't get carried away. Rakshit, let's go to the three-phase chart again. If you want to invest in this, don't get carried away by the last 14 months return, the three-phase, the phase 1, phase 2, 3. Yeah. So don't say, I'm going to invest in CCP because I'm going to get 26.7%. If you want 26.7%, I'm afraid we can't give you 26.7%. Neither are we going to give you minus 14%. Across these phases, earnings growth for CCP has been around 19-20%. CCP's compounding has been a little below that, around the 18% mark. Gross, my reading is in steady state that 18% compounding should be closer to 20%, because over time PE multiples come up and down, and your main driver is PAT compounding. PAT compounding 20%. Assume a little bit of PE derating, you end up at 17%, and take off fees from that, you should be getting mid-teens returns from this product. That's what a high-quality Indian equity product can do for you in the long run.
So I guess given that the Nifty has delivered 12 to 14% in the long run, you're looking at roughly 2 odd percentage points better than the Nifty to answer the question.
Yeah, and this is where I worry about the mania of the last 3 years, right? We had 30 million retail investors in India. Today we have 150 million. And a lot of these people have completely wild expectations of what the stock market can do. They make wild investments basis that, they speculate basis that. And my reckoning is a lot of these guys are going to get cleaned out at some stage in the next 2 years. If that happens, that will reset the whole Nifty construct at a lower level. And it will once again give people a somber point of view that 13-14% from the Nifty, 15-16% from a high quality actively managed portfolio are good outcomes in the long run. But if I walked out into the street today and I told that to people, a lot of people believe that the Nifty is not a 13-14% compounder. It's magically higher compounder, because you can see, right, the last 14 months, people have made 30% from the stock market, and they believe that that's the sort of norm that they will generate for many years to come. We unfortunately can't deliver 30% compounding over any horizon.
Fair enough. Thank you. Thank you so much, Saurabh.
Thank you, guys.
So we'll move to the portfolio specific questions. Rakshit, the questions around the changes, the changes are very well appreciated. The portfolio looks a lot more dynamic and exposed to the right sort of macro environment. This particular move about looking for higher reinvestment rates and taking a little bit of compromise on ROCE, question is, what drove that change?
Right. So, look, there's a slightly different approach to running a business if you're investing only in the core, right? So, take for instance the comparison between say an Asian Paints and say an Astral Poly. Over the last 10 years, Astral Poly's reinvestment rate has been nearly 100%. Right. In fact, here on the screen as well, you can see 91% for the last 4 or 5 years. If you stretch it even back, it would actually at times go even above 100%. So the reinvestment rate for an Asian Paints is half that of Astral Poly. If you compare the 2 rows, you can see the difference between the 2 types of businesses. But because Astral funds expansion into newer categories, initially those newer categories have lower ROCEs, return on capital employed of an adhesives for an Astral Poly at the start of the adhesive journey would be certainly a lot lower than the pipes return on capital employed for Astral. That pulls the average ROCE down. On an ongoing basis, the adhesives ROCE of Astral also trends towards the pipes ROCE, and hence the overall weighted average keeps going up on the older businesses. If the capital allocation keeps going towards newer business additions once every 3-4 years, then that's where instead of a 35% return on capital, you move towards a 25 to 30. The return on capital goes low, but our reinvestment rate goes high. Hence the multiplier of these two columns, which gives you the profit compounding, right? You can do it in terms of the formula, or you can do it practically. It's the rate of cash generation and the rate of reinvestment that gives you the profit compounding, right? So ROCE multiplied by reinvestment rate gives you profit compounding. Whether it be 46% reinvestment rate of Asian Paints multiplied by 34% ROCE, or whether it be 91% reinvestment rate of Astral multiplied by 26% ROCE, it gives you the relevant profit after tax compounding for these businesses. Now, why did we become more aggressive towards Astral types of businesses? In the last 3 to 4 years, the external environment for many industries has undergone a radical shift towards opportunities which didn't exist till 5 or 6 years ago. And this is not just in the home building materials space where Astral operates. This applies in many other industries. So, for instance, the way tube investments is getting into CDMO for exports, optical lenses for mobile phone manufacturing, and in a way being the starting point of electronics ecosystem getting created in future. The way tube is getting into electric vehicles more on the commercial side, not so much on the individual ownership side, more on the commercial side, 3-wheelers, tractors, light commercial vehicles, heavy commercial vehicles. These opportunities till 4-5 years ago didn't really exist. Exports, domestic manufacturing, some of the newer drivers of future demand, such as say electric vehicles, these are newer areas. The old tube investments was largely manufacturing strips, tubes for cycles and motorcycles, 2-wheeler OEMs, chains that go into industrials, heavy duty chains, so on and so forth. That was the metal forming parts, the Hyundai doors that you get. That was the old tube, consistent compounding at a modest pace with high return on capital employed. And then this business has pivoted. There are many more businesses that are making these pivots in the last 2-3 years that we have noticed than the number of such businesses a decade ago, where the core remained strong and the non-core is getting added. There were many businesses a decade ago where without a core, which was strong, non-core was getting added. Disruption was becoming a more frequent feature. Raise capital at cheap prices, and all these tech-oriented disruptors, they actually came up like this. In the last 2, 3, 4 years, rather than raising capital externally to fund growth, a Trent, a Tube, a Narayana, right, and Eicher Motors, they are getting into areas of new business growth, which either are industries that didn't exist, or these companies have figured out a way to create a right to win in these newer businesses. The moment you pivot your investing towards this, the benefit that we are trying to derive from this is you've got a base foundation which is very strong to all of these businesses, right? Whether it be tubes, metal forming business, and the chains and the strips and tube business, or whether it be Eicher's 350cc classic Royal Enfield. That's the base which throws out truckloads of cash, and then we are trying to benefit from the overall consolidated earnings growth being significantly higher than say the typical 17, 18%, 19% that some of these businesses core generates. The consolidated earnings growth getting into the mid to low 20s, in some cases significantly higher than mid 20s as well. The number of such opportunities have become far more available. Our agility to identify such opportunities and bring them into the portfolio before the discovery of these opportunities gets baked into the share prices has also increased. In effect, Bajaj Finance was a great example over the last decade of this. When you compare a Bajaj Finance vis-a-vis, let's say an HDFC Bank or a Kotak, right? Both are lending businesses, but Bajaj Finance kept expanding into concentric circles. From being concentric circles in lending, it then expanded into concentric circles of fee income, which was through its app and the one app and being an aggregator, so on and so forth of e-commerce, so on and so forth, right? So Bajaj Finance is an example. Previously, Bajaj Finance was the entirety of this 10% in the extreme right panel that you see, right? A tenth of the portfolio was exposed to, in a way, via Bajaj Finance, such a high growth earnings compounding with many optionalities. We have upgraded the allocation to this area to more than 50% now. When you look at how Narayana is trying to disrupt the integrated healthcare model rather than just being the IPD insurance-based bed expansion firm, when you see how a Chola is doing what Bajaj Finance did in the last 10 years, when you see how Trent is no more just a West Side and now no more just a West Side plus Zudio. It's an incubator of several retail formats, joint at the hip, delivering high cash generation at a store level and rapid expansion once the unit economics at a store level has been established, rapid expansion of store counts going forward. So, for instance, a Trent Star Bazaar is DMart plus, right? So DMart is just Nestle, Maggi and Britannia biscuits offered at 15-20% lower prices than MRP. That is available at Trent Star Bazaar. But on top, you've got a whole host of private label stuff. To begin with, Zudio apparel, significantly better than, say, a DMart apparel. On top, Fresh, which is a massive driver of footfalls early in the morning for all these stores. Fruits and vegetables procured directly from the farmers, everyday morning delivered to these stores, more than 95% sold on the same day with less than 5% wastage. Freshness same as the mandi, prices same or lower than the mandi. Very difficult to build and replicate. Star Bazaar has done it, and we expect to see scalability. We don't think Star Bazaar's expansion is fully baked into the share price of Trent yet. So these are some of the reasons why we've upped the ante. Number of such businesses were fewer till 3, 4, 5 years ago, pre-COVID, let me put it that way. Our agility has also increased in identifying these businesses. So yeah, that's.
So here's a question which says that, look, we never had any doubt about the fundamental quality of your portfolio companies, nor your ability to do in-depth research on them. It's clearly evident. But this gentleman's point is that the missing piece was the valuation. Even great businesses have a fair value to it. Is there any change in the valuation methodology along with the other changes that you've just talked about? If yes, what are they?
Yes, the biggest change is how we intertwine position sizing with valuations. And the second layer of change is, even at the time of stock picking, if there are two businesses of the same quality, even maybe from the same industry, with very different valuations, then going significantly overweight on the cheaper one. But it's the former which is a bigger change. So let me give you some examples. We've always been talking about post-facto rebalancing, where if a stock falls, we've doubled it, and we've done that quite a few times. 2020 it was Bajaj Finance. I remember 2022 when all this Tata 1mg and PharmEasy news flow was leading to halving of Dr. Lal's share price. We doubled Dr. Lal's allocation at 1,800 rupees a share. I remember July 2022, Titan share price crashed by 20-25% just because the custom duty was increased on gold imports. so on and so forth. I mean, Divi's Labs, November, December 2022, we more than doubled Divi's allocation at around 3,000 rupees a share. So these are some of the changes we already used to do, but we used to do more when the share price would become significantly cheap. The valuation would become significantly cheap in a very short period of time, giving an opportunity to double down on the exposure there. What we didn't do very proactively was the reverse. If the valuation was going significantly up over a relatively shorter period of time, and there were risks emerging on the horizon, we didn't trim as proactively as we doubled down in some of these cases. So that part, I would say, is where I think January we trimmed Titan. In this previous slide, if you see January we trimmed Titan, TCS we trimmed about 4,000 rupees a share. And Nestle, the moment it touched its all-time high historical PE band of, historically it has always traded between 55 times and 75. The moment it touched 75, we trimmed it. That was again 6-7 months ago. So these are some of the changes where the trimming has been done in recognition of an opportunity to benefit from lower valuations, perhaps at a later stage, or more importantly, substitutes which are available at a significantly more attractive valuation price point. We haven't exited from Titan. We haven't exited from Nestle, but these trimmings, they add significantly to the portfolio return. So that's certainly, I would say, the biggest change. Being more aware, being more agile towards position sizing opportunities through valuation. And separately, as I gave an example, when you compare, let's say, Narayana with a Max, when you compare some of these other businesses with their counterparts in the same industries, there are many opportunities to actually benefit from not just high rate of earnings growth, but also maybe add on top discovery elements, which are not yet baked into the share prices of some of these companies.
Great. So we have 15 minutes. We'll try and take as many questions on some of the portfolio companies. First, starting with the elephant in the room, Asian Paints. Obviously, the stock hasn't gone anywhere in the last 3 years, yet the fundamentals have been strong. Clearly, the market seems to be anticipating weakening of fundamentals basis new entry. Why is it still a fairly large, significant position for us?
Yeah, so first and foremost, the moat of Asian Paints is actually significantly superior to the moat of even many of the other companies on this screen in front of you. It's very, very difficult to replicate and add value to the dealers the way Asian Paints does to begin with, and I'm sure many of the listeners are aware of our hypotheses on that moat. Now, yes, it is true. 3 years ago, Birla announced this prospective entry, and 2 months ago, 3 months ago, at the Panipat announcement, they gave out more details. What we haven't yet seen, which is why we stay invested, what we haven't yet seen from Birla is initiatives which are reflective of either a massive short-term threat or a new way to add value to the distributor. So neither disruption nor a short-term, let's say, a price war or something like that, where there is a switch happening amongst the dealers that we should be careful about. Having said that, just to put things into context, the organized paint industry is roughly 75,000 crores, if not 80,000 crores in annual revenues. This is decorative paints. Asian Paints is roughly half of it, right? So it's about 35,000 crores of consolidated revenues for Asian Paints. For a Birla to get to, let's say, 500 crores, 1,000 crores, I don't think that would be such a big challenge, and I don't think that is what we should be. Any shareholder should be worried about. What we need to be worried about is, will that scale up happen into the 5,000 to 10,000 kind of a revenue scale? Because if it does scale up to 5-10,000 in the short period of time, it would certainly start eating into some of the growth that would otherwise have come to Asian Paints. So some of the existing share of dealership revenues that Asian Paints has. At the moment, as I said, we do not see any evidence. We are keeping our ears very close to the ground on this. We do not see any evidence of dealerships which are Asian Paints oriented, undergoing a reduction in the proportion of their allocation of the business to Asian Paints. So remember, there will be two types of dealers that you'll find in the channel. Type 1 is where 75-80% or even higher than that of the dealer's revenue comes from Asian Paints. Let's call it an Asian Paints counter, right? And type 2 will be where 30-40% will be coming from Asian Paints. And then there is another 20 from Berger, another 20 from maybe JSW, another 20 from Nerolac or Dulux, etc. The type 1 provides the bulk of Asian Paints' revenue, right? That type 1 is where the entire business growth of Asian Paints hinges. Type 2 is the low-hanging fruit. Now, within type 2, when that dealer who's selling 30-40% with Asian Paints, if a Birla tries to enter into that counter, the low-hanging fruit won't be Asian, because Asian will be higher ROE for that dealer, ROCE for that dealer, compared to Nerolac or Dulux, right? So the low-hanging fruit will be some of the others, and hence, I think at the moment, with the way the things are progressing at the ground level, there's a lot of noise, there's a lot of news flow. In fact, very similar to what we saw with say Dr. Lal Path Labs, right? Tata 1mg will destroy Dr. Lal. Farm Easy will destroy Dr. Lal, M Fine and Radcliffe and Healthians, and all of these will eat into Dr. Lal, Metropolis, Vijaya, and various other incumbents. This was the view 2 years ago. Obviously, had we been able to foresee the halving of the share price within 2 months, we would have certainly reacted. We would love to have that agility. We hope we have it, a little bit of it at least in future. But had you sold Dr. Lal at 1,800 rupees a share in May, June 2022 because Farm Easy, Tata 1mg were coming in, right? It would have been a lost opportunity to actually make use of that dip. More importantly, an Asian Paints' moat is significantly superior to someone like a Dr. Lal, someone like I would say when Patanjali came against HUL, the moat of HUL, I would say Asian Paints is significantly superior moat than some of these other players. So there have been these examples previously. In the next 6 months, it will all be clear. And hence, in fact, I would say this is the time to take an active call on whether you see Asian Paints winning or losing. Next 6 months, that will get baked into the price. So we are staying invested, keeping our ears close to the ground.
Great. Now, the other, the room is big enough to accommodate two elephants, I guess. We got HDFC Bank with a large position. Stock hasn't gone anywhere. Indeed, the fundamentals have weakened a bit in terms of earnings growth due to the liability side issues. What gives us the confidence to maintain such a large position? And just to overlay a question by another gentleman, not just on HDFC Bank, but also on Asian Paints and some of the other laggard stocks. In this thriving macro environment, thriving market, whilst we do understand the long-term potential, how do we justify these two as sort of relatively more attractive positions than a whole host of other names to hunt from?
Yes. So the second question actually is significantly more relevant than the first, but let me address both. So first of all, why do we keep holding on to HDFC Bank? So to begin with, let me put it in a very simple way. When you look at the NPA cycle of the entire banking industry, right, it goes through significant upswings and downswings. Let's say pick up in SBI versus HDFC Bank NPAs. 2007, 8, 2000, 2007 calendar year, 2013, somewhere around that. These were also two phases of dips in the NPAs of the entire banking system, and hence for some of the competitors of HDFC Bank. Whenever the NPA cycle is very at a benign level, as in the NPA percentages are low, the relative call between, say, an HDFC Bank's valuation vis-a-vis earnings growth versus its competitors' valuation vis-a-vis earnings growth, the relative call becomes a headwind in terms of HDFC Bank. But these remain cycles. As long as an investor believes that the credit quality processes, credit assessment processes of HDFC Bank are far superior, once the cycle reverses, the gap widens between the men and the boys. We expect to see that, which is where slightly in parallel answering the second question. Sitting today, given the valuations and given the positioning of the cycle, when you look out into the next 5 years, we see a very significant opportunity here for high credit assessment banks such as an HDFC Bank. Secondly, there was a massive corporate action of HDFC Limited combining with getting merged with HDFC Bank over the last couple of years. That transaction has taken place, and its aftermath has had an impact on the fundamentals here. And then came the last 6 months of liquidity issue in the deposit industry for the overall banking industry, which adversely affected particularly HDFC Bank, given it had just come out of this corporate action event. So this is how we've seen the de-rating. None of this changes the deposit taking muscle of HDFC Bank. None of this changes in fact, enhances the cross-sell, upsell of products after the HDFC Limited merger, and the quality of the people working at HDFC Bank, which actually becomes the foundation for high quality lending of any bank, that remains pristine. So when you put all of that together, answering in fact the second question as well, as I said, it's very attractively positioned, both in terms of valuations as well as in terms of earnings growth. Combine the two, it's an attractive point to stay invested in HDFC Bank from here on. Same applies for Asian Paints. The valuations are now, in fact, 40% lower than where they were a couple of years ago. As you can see, profit after tax compounding hasn't moderated, and in the next 6 months to 12 months, the expectations around competitive intensity will get delivered, or lack of it, in the reported numbers, and the share price should then reflect that we are trying to capitalize on that opportunity for both of these.
Fair enough. So here's a question on, whilst we are bottom-up investors, to the extent the macro environment also matters in terms of driving top-line growth and earnings growth for businesses, how do we weave in our understanding of the macro into our research and portfolio construction? For example, there's a question which says, it's clear after the ECB rate cut earlier this week, there are going to be rate cuts which will likely benefit the IT sector. Why don't we have any presence of IT? This could be a specific question, but in general, if you could answer about factoring in macro into our portfolio construction.
Yeah, so macro is one of the layers. In some companies' case, it is a thicker layer in the overall add up to earnings growth. In other companies' case, it's a relatively lower attribution in the overall add up to the expected earnings growth. So let me give you, let's say, an example. So a trend has been playing in the same macro as a page over the last, and both I'm taking from our portfolio companies. The degree to which page got adversely affected by the macro was significantly higher than the degree to which trend got adversely affected by the macro, right? So different degrees of attribution, that's one, needs to be recognized, and hence no wonder today trend, in the last 12 months, trend has been a significantly higher allocation than page in the portfolio as we factor that in. The second piece is it's not just macro as one factor from the external environment. It's macro plus regulatory plus near-term expectation of impact on earnings growth of competitive intensity, right? And as I talked about Titan, I mean, lab-grown diamonds is one risk on the horizon. We weren't too worried about it until say December when the prices of natural diamonds crashed by 30-40%, and that became a big alarm bell. And now eventually this risk might not play out, in which case we might position size up. But if it does play out, our position size down on Titan is a defensive call, taken a little more tactfully to avoid a massive hit in the near term on our overall performance from the attribution of Titan, where the external event might not apply in the long term, but could apply in the short term. So those are some of the areas where the agility in position sizing comes in. It's not a one size fit all. Had it been a one size fit all, then the weak consumption would have applied to Trent in the same way as it applied to Page. It would have actually also applied to Titan the way it applied to Page. It didn't, which is where actually the moment you say 50% of the portfolio being exposed to businesses with high reinvestment rates towards optionalities, it reduces the attribution of macro in the buildup of the earnings growth expectation of that company to that extent. So there are various ways. It's not a single line answer, but yes, position sizing is the biggest way to play that.
Fair enough. Last question. This increased agility, what does it mean for portfolio concentration and holding periods / churn? Does it mean that we need more companies in the portfolio, or does it mean holding periods are shorter than previously thought of?
Right. So as I said, previously the churn rates were 10 to 15%. If you reverse that, it gives you the holding period average, which is more like a 6 to 8 years. Now the churn rates should be expected to be around 15 to 20, gives you a more like a 5 to 7 year average holding period. So from a 6 to 8 year average holding period, it's a 5 to 7 year average holding period, given the 5% higher churn thanks to the agility. It does come in exchange for obviously higher value add to the performance, which is higher even after taking into account capital gains taxes that don't get baked into our reported numbers, but at an investor level, capital gains tax getting recognized soon or getting paid sooner than it would have otherwise had we held on to that position for far longer. You would have paid the same capital gains tax to the government later and compounded the money before you paid the capital gains tax. So that small part which sort of moves the needle by say 5 basis points, 3 basis points up or down, basis this 5% higher churn, net result of this 5% higher churn is a positive, significantly positive value add to the portfolio. This agility, it doesn't mean we will take 6 months calls. Let me be very clear. We are not investing in companies where for the next 6 to 12 months we expect certain tailwind, and we are trying to benefit from that tailwind. We are not going to significantly jack allocations up or down on a month-on-month basis. So this is not trading. Let's not confuse agility with trading. And hence I think that's the way That's the way I would say we should look at it.
Fair enough. Thank you. Thanks, Rakshit. Thanks, everybody, particularly to our clients who reposed our faith through difficult times. We are making changes at the process level, but let me remind you, there's absolutely no change in our philosophy. We are focused on quality. We are focused on clean governance companies with high ROCE and well moated. We'll continue to learn. We'll continue to improve the process. That's an evolution by itself. But thank you once again for all of you who've stood by us during these times. These changes have begun to make a difference. As you can see, absolute returns are much better from the difficult period of 2022. I'm pretty sure, as Saurabh highlighted, there will be a rotation out of poor quality stocks into high quality, which should mean that the relative returns should also start showing up. So thanks once again. Until next time.
Thank you, Pramod. Thanks, everyone.